Hello everybody, welcome to Financial Fix. Today we are going to discuss a very important topic that is bothering almost every Canadian homeowner with variable interest rate mortgage. We will discuss what is the mortgage trigger point today, why it happens, how does it happen, and what you can do to push it higher. But before that, let's first watch this video clip.
Interest rates could soon set off a financial bomb for tens of thousands of Canadian homeowners who have a fixed payment, variable rate mortgage. According to one major bank, interest rate hikes are bringing them closer to the trigger point of their mortgage.
According to sources, about 750,000 mortgages are sitting on the edge of trigger point, which means if bank increase the prime rate by 50 basis point or so, they will hit the trigger point. So these 750 mortgage holders would have to either increase their mortgage payments or they have to dump lump sum money to push the trigger point higher. Now let's first discuss the mortgage itself. Mortgage is made up of two components. One component is called the principal and the other component is the interest. So every payment that you make on your mortgage, some money goes towards the principal and some portion goes towards the interest. When banks start increasing its prime rate, more money start going towards the interest. And when your total payment does not even cover the interest charged on your mortgage, that is the trigger point. Let's take a small example. Let's say somebody has borrowed a $500,000 mortgage and they are making $2,000 monthly payment. Now, if it is a variable mortgage, let's assume $1,100 are going towards the principal and $900 are going towards the interest. When bank starts increasing the prime rate, more money would go towards the interest portion. So in this case, let's say when prime rate went up, now 1,000 is going towards the principal and 1,000 is going towards the interest. Gradually, when the prime rate goes up, the mortgage will reach to a point where the total payment, which is $2,000 in our case, would not even cover the interest portion. Let's say the interest portion is $2,100 now and the monthly payments are $2,000. There is a $100 difference. That is called the deferred interest. That deferred interest will get added into the principal amount. So when the principal amount exceeds than the original principal amount, your mortgage is at a trigger point. There's another formula that the lenders follow, that your total equity in the house should be minimum 20%, and that can be determined by reappraising the house. So in many cases, let's say when interest rates are increasing, the effect of that is the property values would gradually start decreasing. So your lender can reappraise the property to determine the market value of the property, and your trigger rate can be decided based on that. Now, every mortgage holder has a different trigger rate. If hypothetically, if we have to guess what is the trigger rate, usually if the prime rate goes by 200 basis point up, you are probably in the range of reaching your trigger point. There's another formula that can be used to calculate your approximate mortgage trigger rate, and that formula is your payment multiply by annual payments, divide by your outstanding mortgage amount, and you multiply that by number 100. That'll give you approximate range of your trigger point. Now this can change. The mortgage trigger point may vary if you have made more payments towards the principal. Some people, they make lump sum payments, some people they make accelerated mortgage payments. So these factors will decide the trigger point. So if you want to know the accurate trigger point of yours, you may have to reach to your lender. And there is another way. The people who have recently borrowed the mortgage, if they look at their original signed contract with the lender, the trigger point is also mentioned there. So that is another way to find the trigger point. I want to discuss another important term here that a lot of people get confused with. In Canada, there are two types of variable mortgages. One is called the adjustable rate mortgage and other one is called VIRM, most commonly known as variable interest rate mortgages. Now, a lot of lenders, they mix these both type of mortgages together and they say variable rate. But indeed, these are quite different and we have to understand the difference between them. So first, let's first briefly talk about the adjustable rate mortgages. Adjustable rate mortgages, as its name depicts, if the prime rate changes, your payment will fluctuate. The mortgage holders who have recently experienced higher mortgage payments when Bank of Canada increased their prime rate, they are having adjustable rate mortgages. On the contrary, the variable rate mortgages payment does not change, but something change in the background. That is the interest portion towards the mortgage. So if you have a variable interest rate mortgage and your payment is not changing when prime rate goes up, you have a firm, that is variable interest rate mortgage with fixed payments, and you are attached to a trigger point, which will happen eventually. So now let's talk about what you can do as a mortgage holder, as a homeowner, to prevent the trigger point. So first of all, I would say you have to call your lender and make sure what is your trigger point. If you're reaching your trigger point, most likely your lender will call you and they will ask you to adjust your mortgage payment, to increase your mortgage payments, to make lump sum mortgage payments, or convert it into fixed term. Now a lot of people ask this question, that is it a good idea to convert right now the variable rate mortgages into fixed rate mortgages? And my answer to most of these, it is not a good idea right now, because fixed rates are really high. It is historically high. The fixed rates are historically high at this point, and if you lock yourself into 2 years, 3 years, 4 year or 5 year term at a higher rate, and on the other side, if banks start reducing their prime rate, you cannot take advantage of that. Now, in order to push your trigger point higher, you can increase your mortgage payment slightly for the time being, and when Bank of Canada reduce the mortgage payments, you can reduce it back to original payment. The other way, if you have some money sitting into your bank account, you can dump it. With the formula, if your outstanding mortgage is lower, your trigger point will automatically go up. I hope today's video was useful. If you have any questions or concerns, you can reach me directly and we can talk about your particular case. Thank you so much. Have a